Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. SunPower reported earnings before the market opened on Wednesday, and results were a little bit mixed. The company's growing really nicely, but a lot of investments made in the first quarter are expected to pay off in the back half of the year. So let's dig into the results and exactly what to expect from SunPower going forward. My name is Travis Hoyam. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get right to the results. I'm going to start with the financial highlights here for the quarter. $440.9 million in revenue. That was up really nicely from $350.3 million in revenue a year ago. But you can see that gross margins are down pretty sharply, 14.5%. That's far lower than what management would like to see in the mid 20% range. As a result, you see a GAAP net loss of $50.7 million or 29 cents per share. The other thing to note here is that cash fell to $116.5 million. All of these items have an explanation, so we need to take a little bit of a long-term view, at least given what management is saying they're going to do. Now we have to actually see what happens in the back half of the year, but a lot of this is an investment in the first quarter that will pay off in the second, third, and fourth quarters. Here are some of the other critical things, and this gives a little bit better look at backlog. 21,000 customers added. That was 27% growth year over year, and 23,000 unit backlog of retrofit homes, and another 39,000 in the new homes channel backlog. SunPower Direct, that's the company's direct to customer channel, grew almost 100%, in SunVault, which is the energy storage solution, has an attach rate of about 20%. This one will be interesting to see as the year goes on, because specifically in California, net energy metering 3.0 could make energy storage a little bit more economical. But this has been stuck around 20% for quite a while. So we'll see how that plays out through the rest of the year. And then the other big trend is that leases as a percentage of sales seems to be rising pretty sharply, up 268%. Right here, you see the new customers and the revenue number. And then this shows the company's guidance for the full year. I'll get to that full year guidance in just a second. But 21,000 new customers is not quite on pace for full year guidance of 90 to 110,000 customers. What management did say, though, is that specifically related to net energy metering 2.0 and the beginning of 3.0, the company was making big investments in sales and marketing in California specifically. The way that the rules worked, basically you had to get to a certain point to qualify for net energy metering 2.0, that cost structure and payback structure. But that system doesn't necessarily need to be installed and running by the time that changeover happened in the last couple of months. So there was a lot of sales and marketing expenses that happened in the quarter, but those installations haven't actually happened yet. That's really the big thing to take away from the quarter, is that there was expenses put up front for installations and margin that will happen later in the year. At least that's exactly what management is telling us. So now we will see if that comes to fruition in the second and third quarter specifically, but that's the story that they're telling. You can see a couple of the company's trends here as well. Obviously, the customer number jumped pretty significantly, but the margin per customer, or adjusted EBITDA per margin, was down. And management does have a goal of $3,000 to $4,000 of adjusted EBITDA per installation. So again, this is going to be impacted by those investments that are made in sales and marketing that will hopefully pay off later in the year. Platform investment continues to grow. This is a number that they keep pulling out. I would actually like them to include this number in their costs as opposed to pulling it out, because it is part of the expense that goes into running the business. But the other thing that has been a positive trend for SunPower over the last handful of years is really the reduction in debt. Net recourse debt now $77 million, down from $281 million. That was on the order of billions of dollars a couple of years ago. So that's a really positive sign. And then SunPower's share of SunStrong, which is the company's leasing arm, which is a part owner of, their share of the value there, they say, is about $270 million. So that's another thing that we need to kind of think about when valuing a stock like SunPower. Here's that full year guidance. And this is the thing that got a lot of pushback on the conference call, because the first quarter numbers don't quite line up with what the company has guided for the full year. But there was a lot of discussion about the investment that was happening and how management thinks that that's going to play out throughout the rest of the year. So still expecting $125 to $155 million in adjusted EBITDA. That was about flat in the first quarter, so that's going to have to pick up really rapidly over the final 3 quarters of the year. Customer growth also going to have to pick up, and then adjusted EBITDA per customer 2450 to 2900, that also is going to have to increase. But the positive thing is management did reiterate this guidance once again. I think the general thing to take away from SunPower's earnings report is that there's a lot of moving pieces and a lot of investment that's happening today that hopefully will pay off in the future. There are a number of tailwinds behind the company. One, there's a lot of interest in residential solar and energy storage. That's partly because of the economics of it improving over the last decade. It's partly because of the Inflation Reduction Act and the incentives that have been put in place there. It's partly because electricity prices for retail consumers are rising on the order of 15 to 20% in some of the company's end markets. So this is making rooftop solar more economical for more and more buyers. And the trend towards leases is really because those are long-term commercial leases. So the interest rate is a little bit lower than it is for something like an individual loan. So that's going to be a dynamic to watch over the future as well. I think my takeaway from the quarter right now is the company's actually growing really nicely. What's lagging is those margins. And management made a pretty convincing case, I think, that the investment that has been made in the last few months will actually pay off pretty quickly here in the next couple of quarters, specifically in California, where they have a huge backlog, which should get them through the third quarter with the backlog that's already on the books. So that should be a tailwind for results. Expect these results to pick up pretty significantly over the next couple of quarters. And if they don't, then it tells us that there's a bigger problem going on. But that was my take on earnings from SunPower. What do you think of the results? Leave your comments in the comment section below. Don't forget to subscribe to Drive Investing. Thanks for watching, everybody. I'll see you here next time.